Welcome back to John Finance. Sometimes reality is stranger than fiction. If someone had said a week ago that the global silver market, a system worth hundreds of billions of dollars, could be brought to its knees because the President of the United States wants to buy a frozen island in the North Atlantic, it would have sounded like a joke. But here we are. It is Sunday, January 18th, 2026, and the landscape just shifted in a way almost nobody modeled. You've probably seen the headlines by now. The mainstream media is having a field day. They're laughing. They're recycling memes about President Trump trying to buy Greenland again. They're interviewing outraged Danish politicians. It's a circus. But while the media is laughing, the bullion desks in London and New York are not. They're screaming into phones. Because buried inside that Greenland tweet, hidden behind the buying an ice sheet headline, is a single sentence that blows a hole in the logistical pipeline of the global silver market. President Trump has announced a 10% tariff on all imports from 8 European nations, including the United Kingdom, starting February 1st. And if a deal for Greenland isn't reached, that tariff jumps to 25% on June 1st. To most people, that sounds like just another trade dispute, politics as usual. But to a risk manager at JP Morgan or HSBC, this is a nuclear event. Here's why. The global silver market depends on one critical idea: fungibility. A 1,000-ounce bar in London is supposed to be economically identical to a 1,000-ounce bar in New York. Same metal, same value, and, crucially, the ability to move that bar back and forth cheaply and easily. The big banks have turned that into a game. Think of it as monetary whack-a-mole. When silver prices rise in New York because local demand is hot, banks pull bars out of LBMA vaults in London and fly them to New York, flood the market, and cool the price. When London runs dry, which it is right now thanks to relentless Indian and Chinese buying, they reverse it. They pull metal from COMEX vaults in New York and ship it to London to refill the shelves. This constant transatlantic shuffle is the lifeline of the current system. It lets banks pretend there is always enough silver because they can always move metal toward the biggest fire. Now ask, what happens when you drop a 10% tariff wall right across the middle of that ocean? The UK is on the tariff list, the LBMA is in London, London is in the UK. That means that starting February 1st, if a US bank ships silver from New York to London to rescue the LBMA and then later tries to bring that same silver back to the US, it pays a 10% tax on the full value of the cargo. At $90 an ounce, that's a $9 tax per ounce. That doesn't reduce profit. It nukes it. It destroys the arbitrage. It makes the entire whack-a-mole game mathematically impossible. In one stroke, the US border just became a one-way valve for silver. Metal can still come in, especially from non-tariff countries like Mexico. But once it leaves for London, it can't come back without blowing a hole in bank equity. That creates a trapped inventory scenario. Right now, on this Sunday, risk managers at the major banks are staring at that tweet and issuing one order: stop all exports. Logistics teams are being told to freeze outgoing shipments. No one is going to risk sending millions of ounces to London if they might need them in New York later and have to pay a 10% penalty to get them home. This effectively cuts the LBMA off from COMEX. It severs the connection between the two largest Western pricing hubs, and it's happening at the worst possible moment for London. We already know from previous vault data we analyzed that London is critically short of physical metal. Flows into India and China have drained LBMA inventories to historic lows. They were counting on the 4.2 million ounces withdrawn from COMEX on Friday to save them. That metal was supposed to be the cavalry. With this tariff, the cavalry isn't coming. The silver that was supposed to be airborne to London is now grounded in New York. That transforms the Friday night heist we discussed earlier. We thought that metal was leaving the country. Now it's likely stuck here. Bullish for US price, catastrophic for London. Because if London can't source supply from the US, and it can't get enough from miners quickly, how does it settle its contracts? It doesn't. It heads toward a physical default much faster than New York. The Greenland tariff is a genuine black swan. Nobody priced it. Nobody modeled a scenario where an Arctic real estate dispute jams the core plumbing of the silver market. The algorithms that trade silver tick by tick are tuned to interest rates, dollar moves, industrial data. They are not built to reprioritize flows over an ice sheet in the North Atlantic. That's why human analysis suddenly matters again. Where machines see a generic trade war, we see a liquidity trap. Now the banks are being forced into a decision they never wanted to make. They have to choose which market to sacrifice. They can keep their metal in New York and let London burn. Or they can ship metal to London and accept that once it crosses the Atlantic, it is effectively trapped there, leaving COMEX exposed. They cannot fully protect both. Because most of these institutions are U.S. domiciled or heavily exposed to U.S. regulators, the rational move is obvious. Circle the wagons around COMEX, protect New York, let London take the hit. That leaves the LBMA directly exposed to the full force of Asian demand. Shanghai is still vacuuming metal, India is still buying, and now the New York lifeline is cut. We are about to see a bifurcation of the Western silver market. It is entirely plausible that we will see silver at $90 in New York and $110 in London simply because metal cannot move between the two cities. The law of one price just got repealed by executive order. In the next part of this deep dive, we'll go deeper into the mechanics of this trap. We'll unpack the Roach Motel effect in commodities. We'll show how this tariff structure forces banks to hoard metal domestically, even when they would prefer to arbitrage it. It literally turns them into reluctant preppers. And we'll talk about why this accidental policy might be the most effective America First move for critical minerals we've seen. It unintentionally locks in domestic supply by making it too expensive to export real wealth. The media can joke about Greenland. But the people running bullion risk books are not laughing. And if you're a serious silver stacker, this is exactly the kind of structural break you need to understand. Because the walls around the system just got higher, and the silver is locked inside. With you. Now we need to talk about a concept that is life and death for bullion banks, the location swap. In a normal, friction-light world, silver behaves like water. It flows to where it's needed. If JP Morgan has too much silver in New York and not enough in London, they don't always move metal first. They swap book entries. They trade ownership of specific bars in New York for ownership of bars in London with another bank. The physical shipping happens later when it's convenient and cheap. The whole system depends on the assumption that, sooner or later, metal can be moved to balance those books without punitive penalties. It assumes an ounce of silver is worth effectively the same on both sides of the Atlantic. The 10% tariff just shattered that assumption. The U.S. bullion system has become a Roach Motel. You know the slogan, roaches check in, but they don't check out. Now it's silver checks into the U.S., but it doesn't check out. Put yourself in a bank's seat. It's Sunday. London is desperate for silver. On paper, you'd love to ship 1 million ounces from your COMEX vault in New York to your LBMA vault in London to calm the spike. Sending it is easy. No export tax. Load it, fly it, land it, deliver it. But what happens next month when COMEX gets tight and you need that metal back to satisfy U.S. delivery? That's when the trap snaps shut, because now the moment that bar leaves the UK and heads back to the U.S., Customs slaps a 10% tariff on the metal's value. At $90, that's $9 per ounce, straight to the U.S. Treasury. In a low-margin business like bullion banking, a 10% haircut is not just a bad trade. It destroys the economics of the whole loop. It turns what used to be a safe balancing mechanism into a guaranteed loss. So risk control looks at the model and says, we can't send this silver. Once it leaves U.S. soil, it may as well cost us 110% to repatriate it. The silver is effectively trapped. That breaks the whack-a-mole game. Banks can no longer smoothly dampen volatility between the hubs. If London runs to 120 while New York sits at 90, they can't step in and close that gap through physical flows. The tariff wall blocks the trade. That creates segmentation. One asset, multiple prices dependent on geography. Here's the unintended genius. By trapping silver inside the U.S., the policy has accidentally created a strategic reserve. We've talked before about critical minerals, national security, and the U.S. Mint's ongoing struggles to source enough metal. This tariff fixes that problem instantly, without ever mentioning silver in the press conference. If banks can't comfortably export silver to London, that inventory stays here. It stays in COMEX vaults. It stays available for Tesla. It stays available for Raytheon. It stays available for the U.S. Mint. It forces ghost supply to remain within U.S. borders. It's America First, applied to the periodic table. Europe and the UK are suddenly on their own. London has effectively been told, you cannot raid U.S. vaults whenever your exchange is in trouble. You will have to fend for yourself. That puts LBMA into a potentially fatal spiral. London is the physical hub for metal flowing into India and China. If London loses access to U.S. stockpiles, there is almost no buffer left. We know vault holdings are already thin. We know the free float is tiny. Now the main resupply line is cut. This also changes the meaning of that 4.2 million ounce COMEX withdrawal on Friday. On Friday, it looked like metal was heading out. With this tariff, that metal is likely sitting in a warehouse near JFK, wrapped and waiting, with nowhere economically rational to go. The owner faces a simple choice. Ship it to London and accept future tariff risk, or keep it in the U.S. and sell to domestic buyers. Given the uncertainty, the logical move is to keep it domestic. Short term, that might ease the US squeeze a little, but in London, the physical shortage just got upgraded to critical. And because silver is a global asset, a break in London reverberates everywhere. You can't have silver at 200 in London and 90 in New York for long without something snapping. There's another layer: refiners. Many major refiners serving the US market sit in Europe and Canada. If a blanket tariff hits goods from these nations, imported refined silver just got 10% more expensive. That raises replacement costs for US dealers. If APMEX or JM Bullion wants product and the US mint is constrained, they turn to private mints. Those mints buy silver grain from refiners. If that grain now carries a 10% tariff, their costs jump overnight. Even if spot sits at 90, physical premiums in the US are poised to rise again as dealers adjust for higher input costs. The 120 street price we talked about now has fresh justification. The tariff effectively builds a permanent floor under physical premiums. What you're watching is the balkanization of the financial system. The era of frictionless globalization is over. We're heading into a world of walls, tariffs, and trapped assets. In that world, actual possession matters more than any screen quote. You do not want to depend on a contract for silver in London if London can't source delivery. You don't want all your exposure tied to an ETF that parks metal in a tariff-targeted jurisdiction. You want metal you can directly reach. The Roach Motel effect means any silver entering the US system is effectively stuck. The state, the banks, and the industrial base will hoard it. The shell game stops. The banks are pinned. They have to show their hand. And when that hand is shown, the world will see that most of what they're holding is paper. In the next segment of this deep dive, we'll move across the Atlantic and focus on London. We'll look at why Monday morning could be the start of a historic local default. New York is trapped. London is starving. Shanghai is feasting. The logistics are broken. Price is next. Before we go there, a quick housekeeping note. We are boring currency. We are the original source of this analysis. We spend hours connecting geopolitics and market plumbing. Lately, we've seen copycat channels using the same AI avatar, lifting scripts word for word. To be crystal clear, there is one channel, this one. No official Twitter, no Telegram funnel. If you value the forensic work we do, help protect this community. Drop a comment saying, "Staying with the original," so the algorithm knows you're here for the real analysis, not a copy-paste clone. Now back to London. The bifurcation of the market is a nightmare for banks because it blows up their hedging logic. A global book might be long silver in London and short silver in New York. Under normal conditions, those positions offset. The bank is hedged, but if London starts screaming higher while New York lags, that hedge stops working. They begin losing money on the spread. That forces them to rebalance, buying back shorts in New York and selling longs in London. That buying pressure in New York actually pushes U.S. prices up. So the idea that trapped inventory automatically crushes U.S. prices is wrong. It can create a panic bid as banks scramble to repair broken books. Then there are the unallocated accounts in London, millions of ounces promised on paper with fractional metal behind them. It's essentially a fractional reserve system for silver. If London is cut off from new supply, the default risk on those IOUs surges. Holders of unallocated ounces are basically unsecured creditors of banks that just lost their main resupply option. When the market really grasps that London is under siege, a run on unallocated accounts is likely. People will race to convert unallocated claims into allocated bars. But there aren't enough bars. That forces LBMA banks to hit the open market and bid aggressively for any loose metal. That's how a liquidity squeeze morphs into a solvency crisis. The Greenland tariff has exposed exactly how fragile this structure is. It shows that the silver market isn't a single ocean. It's a set of connected but very different pools. London is draining. New York is filling with capital that can't leave, and that makes the U.S. the safest physical market on paper, at least for now. If you own physical silver inside the U.S., you are holding strategic inventory. If you own paper claims in London, you're holding risk. This divergence will likely create chaos. Monday morning, we may see arbitrage bots fail to keep spreads tight. That's what happens when logistics break. The pricing mechanism stops doing its job, and that 4.2 million ounces almost certainly stuck. Its owner is sitting on a pile they can't export without an immediate 10% loss. So they'll wait, or they'll sell domestically, to an industrial buyer or to the U.S. Mint. That implies domestic supply can stabilize, but only at much higher prices. A tariff aimed at European imports and wrapped in Greenland jokes just triggered a structural crisis in the City of London. In a market already running on fumes, that's like dropping a match on a dry forest. London is burning, the bridge is cut, the fire will spread. From here we move into the era of regional pricing. Silver in the US as strategic metal, silver in London as stranded metal. Silver in Asia as actively pulled metal. That destroys the old dream of a single unified spot price. Suppression requires seamless flow and predictable rescue trades. The tariff injects basis risk, the one thing banks fear most. If you can't move metal to close spreads, your hedge stops being a hedge. At that point, big players stop pressing shorts and start backing away from leverage altogether. Without constant paper suppression, silver is finally free to drift toward a true equilibrium. Whatever price is high enough to justify new mining projects in a world of expensive energy and rising costs, and high enough to reflect its real role in the digital and green economy. So what does all of this mean for the individual stacker? First, geographic diversification is overrated in a world of weaponized trade. Moving metal across borders is getting harder, not easier. The safest silver is the silver you can reach. Second, stop obsessing over the screen spot price. That quote is now basically an average of multiple broken markets. Value your stack based on replacement cost. If you sell today, can you actually buy the same ounces back? At what premium? Third, think long game. A tariff on the UK is likely only one domino in a broader move toward resource nationalism. Countries will start hoarding what they have. We're heading back to a world where tangible collateral is what counts. The tariff trap has locked the door. The silver is staying in place. Expect noise this week. Expect confusing statements, spin, and maybe one last attempt to shake the tape. But you know what changed. The logistics. The government has accidentally tilted the board in favor of physical holders. The floor is rising. The ceiling is undefined. $90 won't be the reference point forever. So hold your position. Don't let engineered volatility talk you out of your own plan. The path from here will be messy. But for patient, informed holders, the long-term direction of physical value is up. If you're here for the real research and not the clones, drop "I'm staying with the original" in the comments. This week will be one for the history books. Stay focused on the physical reality, not the paper illusion.